Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm speaking to you from the Borough of Queens. It is the 11th day of October 2022. I do like to remind you I publish a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. You can go sign up for that by going to miningstocks.com. And Michael Oliver, who is with us today, publishes an excellent newsletter, one that has really saved my life in a number of ways, in the gold markets anyway. I'm really a big fan of Michael, which is why he's here every other week on a regular basis with us. OliverMSA.com is the place to go to sign up for Michael's letter that deals with structure and momentum and a different way of looking at things, and it's served his clients very, very well. So Michael, as I said, will be with us shortly. And, of course, we want to thank all of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. And you can always send in your questions, any comments you have about this show by going to questionsfortaylor@gmail.com, questions4taylor@gmail.com. And we do want to thank our sponsors for making this show possible. This week's sponsors: Irving Resources, Novo Resources, Gold Bull Resources, El Oro Resources, Reina Gold Mining, and Lion One Metals. I've titled today's show, Was the BOE's Pivot a Warning of Things to Come? Alistair McLeod, Michael Oliver, and Dr. Quentin Henning return as guests today. With regard to the title of today's show, based on news from the Bank of England just this morning, it seems as though the answer to the question asked in the title of today's show is yes. It does seem that the Bank of England's actions on September 28th are, in fact, a warning of things to come, because just as I said just this morning, we learned that the Bank of England central bank, that is England's central bank, the Bank of the BOE, has expanded its bond buying program amid a historic rout in the bond markets with the stated aim of ending the fire sale and halting the market dysfunction. Well, for those of you who may not be familiar with what took place on September 28th, the Bank of England announced it would begin buying the 30-year UK Treasury bonds known as gilts when the rate on those bonds reached a 20-year high of over 5%. It did that because pension funds and other institutions were very rapidly approaching insolvency and a major liquidity squeeze as interest rates were adjusting closer to their natural rates, leading those bonds purchased by pension funds with severe losses. Of course, the Bank of England is just one of all central banks that have engaged in this damaging market rigging interest rate scam that goes way back essentially being enabled by President Nixon back on August 15, 1971. But it has been progressively more and more debt has been getting these countries into more and more trouble, and it does seem as though we may be nearing the end in some sort of very unpleasant fashion. So the fear of a liquidity crisis among pension funds is it's caused by these rising rates, and that prompted the Bank of England to pivot on September 28th, as I said, even though it was expected to raise rates on that day by as much as 1%. Alistair McLeod emailed me on October 4th stating, and I quote, "The Bank of England's action probably was a turning point. Equally, it could be claimed that the public discovery that Credit Suisse has issues could have persuaded the Fed that higher interest rates bring forth systemic risks. We may have a clearer idea on the 11th of this month when I'm on your show the next time." End of quote. Well, as far as I know, the Fed is not buckling under to growing pressures in the markets from England and elsewhere. Of course, all these markets are intertwined, and so face masks and isolating in place won't deter the virus any more than it did COVID. It won't deter this financial virus any more than it did the COVID virus. We will seek Alistair's take on prospects for the global market, especially it's interesting to have him on again just this day when the Bank of England has added to their QE program that was initiated on the 28th of September. Right after our first commercial break, we'll be talking to Dr. Quentin Henning. He'll join me to give us an update on one of the most exciting gold exploration stories that I cover in my newsletter, that being the story of a major high-grade alkaline gold deposit in Fiji that Lion One is moving towards production on. Last week, the company reported some more very high-grade intercepts that we will ask Quentin to comment on when he joins me after the first commercial break that will take place in just a few minutes from now. But until we get there, I'm happy to tell you that Michael Oliver is with me once again. Thanks again, Michael, for coming on our show.
I'm glad to be here.
2 weeks ago on this show, you explained why you couldn't join a loud and growing chorus of price-oriented technical analysts who were suggesting gold was in a very strong bear market. And I want to thank you personally, again, because you've kept me from getting whiplashed in and out of these gold markets over the years. Since you've been on this show, since I first learned of your work, it's been very helpful to me, and I'm sure to countless other subscribers. So I want to thank you very much. But I'm wondering, now that gold has rallied a bit, since you saved a lot of us from selling a couple of weeks ago, what is your take on the gold markets right now?
Well, it's at the end of last month, we recalculated a lot of numbers because a lot of our key moving averages shifted, and therefore the point at which certain momentum trend structures would break, either upside or to the downside, also shifted because those averages shifted. Okay, so we recalibrated a lot of things, and especially in the case of the dollar and gold, we specified very precise numbers that if you trade on in the dollar to a given level, that we thought it was over. The dollar had in fact peaked. Well, instead, what did we have? We had a sell-off in the dollar early that stopped exactly 0.1% in front of our number and then rebounded. Okay, so what did that tell us? Does it say, well, it's holding support? No, it's holding a level on momentum that it's used 5 times now in the last 4 months. Oh. Not on price, can't see it on price, but a momentum chart, it's a flat floor. It's used it now 5 times. When we see that kind of behavior, we know that our numbers are good, meaning you better not go back there again. Now, that number's below you, so we know where it is, and if you go there, it's just below the low of last week, again, by 0.1%. It's over. Dollar rally, I think, is over at that point, in which case you get downside. What would cause that? Well, there seems to be this ongoing sense that, dollar's going to go up to 120. I'm talking dollar index now. And euro's no good, yen's no good. They're all no good, okay? It's all a relativistic measure. But the problem is, what you've just mentioned is we now have a bond market problem, not just with rising rates everywhere and dropping prices, and therefore pension funds are in jeopardy and so forth. But in the UK, it's become a situation so that they had to intervene, they had to alter policy. Now, we can't sit over here and say, well, we're in good shape, we don't need them. That's not true. Yeah. Okay. Remember the 1998 collapse in the certain major hedge fund, and the stock market broke hard because of the collapse in the Thai baht, and also the Russian ruble had a problem. The Thai baht, okay, we're talking British pound now. Okay, we're talking a major crisis problem, and when they get at this level, where the Central Bank of England has to literally reverse course overnight and go from raising rates to the opposite, that tells you how close we are to chaos theory. In other words, rather than an incremental trend, as we've had for some months now, it could go dramatically rapid. To where all of a sudden it's like 52-card pickup in a lot of markets, not just in their markets. Then at the same time, at the close of last month, gold was at 1660 area. We put out a number on gold that we wanted to see a daily close above. So what did gold do? It ran up to our number, traded above it, and closed the peak day of this month $1 below our number, and since pulled back. So 0.1% difference on the dollar index and $1 short of our number on gold. Those numbers are now highly validated because of the response we've just had to those numbers, meaning they didn't break out. You better not go back there again, because the market, in effect, has marked the spot. Do I think those numbers will be triggered? Highly likely, because of the nature of the events that you discussed before I came on. We now have a non-incremental trend crisis. and it's highly likely to snap the necks of central bankers around the world. I don't care what they want to talk about, inflation and so forth. Their ultimate goal is to defend the state, defend the debt of the government, and if all of a sudden that becomes in jeopardy, we're no longer talking mortgage-backed securities, we're talking government bonds. Mm-hmm. Okay? So no matter what comforting things Ben Bernanke said the other day about, this isn't comparable to 2008, well, got to remember back then, Bernanke said there's no real estate crisis.
Right. Yep. That's what he said.
He says, oh, no, there's no problem with a government bond thing. It's not a big deal. So take him at his word. Fade him. So I think we are literally at a point in market time where many of the markets that we're all interested in could move rapidly because of these dynamics of these events that were not on the plate of the Fed when they started raising rates. They had no concept that the sort of things could happen that are happening. And so I think its 52-card pickup could be right around the corner.
Yeah, it wasn't in their Keynesian playbooks. The Austrian economists have been predicting this day for years and years. They've been a little premature, but it looks like it's about to happen, unfortunately. Well, what about silver, Michael? With a couple of minutes left, you were thinking,
it's still the screaming child, but it's recent action. We measure it week to week and also month to month versus gold. And I don't mean just the spread chart where you plot the price of silver versus gold, but we measure the momentum of that. And as far as we're concerned, the close last month was a breakout, indicating there's a shift in the relative performance of silver to gold to the positive, meaning silver should outperform gold going forward. That doesn't mean every day is going to reflect that, no, period. But the big picture says that relative shift, which is disfavored silver since early 2021, it's been underperforming gold, has now shifted back to positive. And what's good news about that is there's a high correlation between the relative performance of silver versus gold and the net trend of silver versus gold. Silver and gold, excuse me. So if silver shifts to an outperform status, if you go back and look, you'll also see that around that time, gold and silver will turn up in price, with silver at the lead. And similarly, if it goes the other way, for instance, in early 2021, the silver-gold ratio turned down by our metrics. It didn't collapse. It just eroded for a year and a half. And sure enough, what happened to the silver market? It eroded for a year and a half consistently, and gold went to the bottom of its range and popped through it for a week or two. So, but that spread has now shifted. So I think it says that that's another thumbs up in the background of the gold to silver market. But again, we have that specific number on gold that was missed by $1. So we highly respect that number.
It's remarkable.
I suspect we're going to see it.
Remarkable work, Michael. You get that close to the markets. And we're really almost out of time here, but if you can just give us your thoughts on oil and gas real quickly.
Oh, I think that the key there is that it's not an issue of whether they go up or down in a range. It's whether they hang around. That's the lethality of the energy markets right now in terms of the world economy. You don't have to collapse oil or take it up big, to do good or do bad to the economy. Just hang around, $10 or $15 either side of $100 crude, and that's choking to the global economy. And frankly, I think that's about the worst you're going to see out of oil over the coming several months. It's already been in that range for a while now anyway. Yeah. So it's the issue is the high level it's already at simply being maintained. That's where you get the strangle effect. And the same is true with natural gas, which is trading, between $6 and $10, which is, way above its $1.40 low it made in summer of 2020. So that's what I think about the energy markets.
Well, that's the natural gas price in North America. In Germany, it's quite a lot. That's another story. I mean, that's part of the whole issue that we're talking about here. Things are spinning out of control, it seems, in many ways. Michael, thank you so much for spending time with us again. Always great to have you.
Thank you, Jay.